This is Richard Flax at MoneyFarm with our regular monthly update. October was a bit of a repeat of September in financial markets. Global bonds, measured in sterling, eked out a small gain, while global equities saw another strong performance, rising close to 5%. Gold was more volatile, but still ended the month up around 6%. Within equities, the picture in October mirrored the previous month. Emerging markets outperformed, followed by the US, while European equities lagged behind. On the policy side, we saw another 25 basis point cut from the US Federal Reserve, very much as expected. Investors have been looking for another 25 basis point cut in December, but Fed Chair Jerome Powell highlighted in his comments that another cut wasn't guaranteed. At the same time, the US Central Bank also announced that it would stop reducing the stock of bonds it holds from the 1st of December, so-called quantitative tightening, suggesting that it doesn't want to remove any more liquidity from the financial system. Turning to Europe, the European Central Bank kept its policy rates unchanged in October, again largely as expected. In the UK, we saw government bond yields move lower last month on the back of a better than expected inflation report. Inflation is still well above target, but if we continue to see softer macro data, then we could yet see a rate cut in the UK before the end of the year. On the corporate side, we've seen a raft of earnings reports coming out over the last few weeks, particularly in the US. As you might expect, large tech companies were a particular focus of attention. In general, the results for these tech businesses was pretty strong, even compared to high expectations. There remains some concern about just how much money these businesses are spending on their AI rollout, and when we'll see these companies get the benefit of that investment. This is going to be an ongoing focus of attention, but for now, these businesses are growing fast and remain very profitable. Looking at key data points, the September UK inflation figure caught our attention. It rose 3.8% year on year. That's well above the Bank of England's 2% target, but it's still below the 4% figure that most economists were expecting. The Bank of England has had to contend with high inflation and weak growth for some time, and the September data release will have come as a welcome relief for policymakers. The case for cutting rates in the UK is getting stronger. We wanted to think about what we've learned from the US third quarter earnings. Company reports provide useful updates on the current state of the business and taken together can give a decent picture of the underlying health of the economy, if only in the recent past. The message from this quarter's earnings season has been pretty clear. Listed US companies, in aggregate, remain in pretty good shape. They're continuing to grow and their profit margins are very healthy compared to history. But it's also worth highlighting that a lot of that strong performance comes down to a relatively small number of large tech companies. They're spending aggressively, often with each other, in order to capture the potential gains from artificial intelligence. That raises a couple of questions. First, can these companies continue to produce such strong results? And second, what about all the other US companies? The first question continues to dominate discussion among investors. For now, these companies continue to generate strong growth and invest for the future. But expectations are high, and it's still to be seen how quickly companies and households will really adopt, benefit, and pay for AI. On the second point, the non-tech world has shown decent results. More companies than usual have beaten analyst expectations. But we are seeing some softness in the labour market, and not just from announced layoffs in tech. So results have been solid for now, and generally better than expected. But we'll have to see how much a weaker job market impacts consumer demand. Thank you for listening and look forward to speaking to you again soon.